China just scored a U.S. trade deal better than Japan, the EU, and South Korea combined. Tariffs slashed, tech exemptions granted. While allies still face 25%, Beijing walks away with 30% and no concessions. Wall Street's reacting like we lost a war. Treasury yields are spiking. Investors are dumping U.S. debt, and deficits are exploding. Trump's calling it a win. But behind the scenes, Washington's now forcing allies to buy American goods just to avoid new penalties. This isn't diplomacy, it's an ultimatum. And if the world loses trust in that, the dollar won't just fall, it may never recover. China didn't negotiate, it waited. And when the U.S. blinked first, markets responded with brutal clarity. Within 72 hours, tariffs collapsed from 145% to 30%. Triggering a bond sell-off across maturities. The 10-year Treasury yield surged to 4.5%, its highest level in nearly 2 years, while the 2-year spiked to 4%, a move Goldman Sachs analysts flagged as market disbelief in fiscal restraint. Bloomberg reported that global funds began dumping U.S. debt in favor of cash, a sign investors are more comfortable holding dollars than trusting long-term U.S. credit. Despite a rising dollar, bond prices dropped, revealing a growing divergence between currency confidence and trust in government solvency. What began as a trade reversal is now morphing into a macro-level vote of no confidence. But if a 30% tariff rollback shook bonds this hard, what happens when the real cost of that retreat shows up in deficits? On paper, Beijing should have been cornered, its exports to the U.S. down over 20% year over year. But the real numbers told a different story. According to China's Ministry of Commerce, overall export earnings rose 8%, driven by diversified markets in Southeast Asia, Africa, and Latin America. Since 2008, China's export reliance on the U.S. as a percentage of GDP has fallen from 1.8% to just 0.8%. The U.S., however, remains deeply tied to Chinese manufacturing for consumer electronics, raw materials, and intermediate goods. Inflation in the U.S. sat at 2.4% in April, too high for stimulus, too low for complacency. China, facing near zero inflation, retained policy flexibility. When Beijing slashed tariffs, first to 80%, then floated 34%, then finalized 30%, China hadn't moved. They didn't concede. They collected. Washington gave ground without extracting anything Beijing hadn't already priced in. And that raises a sharper question. Was this even a negotiation or just the end of one? Equities soared on the surface narrative. The S&P 500 gained 2.1% in a single session, while Hong Kong's Hang Seng jumped 3.4%, reclaiming all post-Liberation Day losses. But the bond market saw through the facade. U.S. Treasuries, normally the safe haven of choice during uncertainty, were being sold at speed. The 30-year yield surged to 4.9%, a level not seen since 2022, while mortgage-backed securities saw outflows totaling $12.7 billion in the last 5 trading days, according to J.P. Morgan tracking data. That dislocation, stocks up, bonds collapsing, is rare. And it suggests markets believe inflation is about to become embedded. Supply chain repairs will take months, but the 30% import surcharge begins now. Importers either raise prices or bleed margin. Meanwhile, new bond issuance required to subsidize reshoring will deepen deficits, sending more debt into a market already rejecting what it sees. If investors are running from long-term U.S. debt, the next fiscal lifeline might already be out of reach. Pause. Because we just crossed a line no one thought we'd reach this fast. This wasn't a policy rollout, it was an emergency landing. The Trump administration's public posture was uncompromising, but behind closed doors, it was the U.S. chasing Beijing to neutral territory. Sources close to the talks confirmed the Geneva meeting was brokered after China suspended exports of 7 rare earth minerals, materials critical to aerospace, EVs, and chip making. That move cornered U.S. industry supply chains, triggering panic across sectors already stretched thin. In exchange for lifting those controls, Beijing secured a sweeping tariff rollback without offering any currency reforms, export quotas, or structural market concessions. Traders read between the lines. As Reuters reported, volume-weighted bond futures trading on the CME exploded by 47% that week, a clear indicator that major funds were repositioning in response to policy instability, not relief. If this was the compromise made in crisis, what would the U.S. give up under pressure? The backlash from allies began within hours of the announcement. Japan's finance ministry expressed grave concern after learning its exports to the U.S. remain under a 24% average tariff, while China's, despite being a geopolitical rival, dropped to 13% with tech exemptions intact. Taiwan's exporters now face a 32% barrier, and EU trade officials confirm that Brussels has formally requested parity treatment in light of Beijing's concessions. Germany's auto sector, still absorbing a 25% tariff, is furious that Chinese EVs will enter the U.S. market with fewer restrictions. According to data from the Peterson Institute, the average tariff on G7 allies is now within 6 percentage points of China's, despite years of defense cooperation and market alignment. Trump's framing of the deal as a win for American leverage has only deepened diplomatic strain. If allies are paying more than adversaries to access the U.S. market, how long before loyalty gets traded for leverage? Washington isn't just seeking market access anymore. It's demanding purchases. As part of the new UK trade agreement, the British government pledged to buy $10 billion worth of Boeing aircraft, according to a press briefing confirmed by Bloomberg. In return, Rolls-Royce components for US-bound jets received tariff exemptions. This isn't an isolated case. It's now the blueprint. The U.S. is tying tariff relief to hard commitments. Commercial planes, LNG cargoes, farm exports. These are no longer free market deals. They're procurement packages dressed as diplomacy. For allies considering reshoring to the U.S., the strategy is creating a paradox. Do you invest in American factories if your survival depends on tariffs staying high? Or just agree to buy U.S. goods and skip the risk? The answer is tilting toward the latter, and the manufacturing base in places like Ohio and Indiana may be left waiting. And with the White House offering relief to rivals before allies, some of those allies are starting to wonder, are they the next trade targets? The tariff rollback triggered bond turmoil, but for U.S. allies, it also lit the fuse on something darker: competitive devaluation. Japan's 30-year yield spiked to 2.6%, the highest since 1998. German bonds surged nearly 3%, forcing Berlin to publicly commit to fiscal restraint. Higher borrowing costs mean thinner margins and weaker exports, unless currency values fall. As Bloomberg's Simon White noted, this environment creates a strong incentive for nations to weaken their own currencies to regain trade competitiveness. Japan is already signaling a return to yield curve control, which would cap rates and devalue the yen, boosting exports but crushing domestic purchasing power. South Korea and Switzerland are under similar pressure. Currency devaluation in parallel with rising U.S. tariffs creates a volatile feedback loop. Falling currencies fuel exports, but imports get more expensive and inflation rises domestically. Reshoring, which depends on long-term cost stability, becomes unworkable. If countries now see devaluation as the only path around American tariffs, how long before the next Plaza Accord becomes inevitable? A 30% tariff isn't just a line item, it's a tax on recovery. With Chinese imports still throttled from months of supply disruptions, U.S. firms now face steep costs to rebuild inventory. According to the Bureau of Economic Analysis, imports from China dropped 17% in Q1 2025. Creating shortfalls that still haven't been replenished. When shipments resume, prices will carry the full tariff burden. Companies squeezed by higher input costs will cut jobs or freeze wages. Meanwhile, Trump's promised tax credits for reshoring, combined with rising subsidy demands from struggling sectors, are set to balloon the fiscal deficit beyond the CBO's $1.9 trillion forecast for FY 2025. Treasury issuance is expected to climb by $1.2 trillion in the second half alone, according to J.P. Morgan estimates, pushing yields higher in a market already pricing in long-term structural inflation. Every policy lever meant to stabilize the economy adds to the debt load investors are rejecting. And if layoffs begin before the supply chains recover, the pressure on the Fed to intervene will rise. just as its credibility begins to fracture. This wasn't just a trade adjustment, it was a global capital trigger. As US and Chinese equities rebounded, capital flooded out of sovereign debt worldwide. German bonds, UK gilts, and JGBs all saw yields spike by over 2 percentage points within a week. At the same time, the dollar index rose 1.2%, signaling rising global demand for dollar cash, not dollar debt. Safe haven currencies like the yen and franc depreciated sharply, while Taiwan's central bank confirmed intervention to slow capital flight. The core signal markets are now pricing US fiscal instability into global risk models. If treasuries are being sold and the dollar is being hoarded, we may be entering a liquidity preference regime, where institutions prefer holding dollars to bonds, gold, or foreign reserves. According to BlackRock's macro outlook, this shift could reprice sovereign credit risk across both developed and emerging markets. If US allies no longer trust Washington's long-term policy signals, what happens when that skepticism spreads to the dollar itself? The tariffs came down, markets bounced, speeches were made, but beneath the calm, a new system is taking shape, where trade deals are coerced, allies are bypassed, and capital no longer follows rules, but instinct. If nations now compete through currency manipulation and forced purchases, the old order of trust, credit, and fairness fractures. And if that fracture widens, the next global crisis won't start with a headline. It'll start with a silence, when no one shows up at a bond auction. So ask yourself, if this was the deal that restored stability, what happens when the next panic begins and no one wants to buy the debt that props it up? We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.